Assalamu alaikum everyone. The topic I'm going to cover today is the risk-weighted assets and the capital adequacy ratios that are required by BASIL III. So I have a question today. There is a bank and it has the following portfolio of assets, and you need to find the risk-weighted assets. So to calculate the risk-weighted assets, what we have are some particulars, some assets that the bank have, their value, and the risk weight given by the authority. In Pakistan, that authority is State Bank of Pakistan. In America, that authority is Fed. And we have to find the risk-weighted values. So before we find the risk-weighted values, we must know what are the risk-weighted assets. Risk-weighted assets are referred to to the total amount of assets held by the bank, but after adjusting for credit risk, market risk, and operational risk. This is very important, that there are three types of risks that we are adjusting for before to calculate the risk-weighted assets. Essentially, an asset value depends on the risk. And this risk weight is used to find the capital adequacy ratio, not the total assets, but the risk-weighted assets. The second thing is, what are the risk weights? What do these risk weights represent? So risk weights are a standardized measure assigned to different type of assets. For assets with extremely low credit risk, market risk, or operational risk, the risk rate could be 0. For example, with government securities. And for securities where the market risk is extremely high, such as shares, what we see is an extremely high risk weight. So once you understand what risk weights and risk weighted assets are, you can calculate these two things. So how do you calculate the risk weighted value? To find the risk weights, all you have to do is multiply the value of the asset into the risk weight. So that's equal to 20,000 multiplied by 0%. That's a 0 risk weight. And for shares, it's 2,000 multiplied by 125. So risk weighted value of shares is 2,500, not just 2,000. Repeating the same process for the securities. So multiplying the two things again and again for all the securities, 15,000 into 0 and 50,000 into 50%. Repeating this process, what we have, we can find the risk weighted value of all the assets. Once we have the risk weighted value, we can find the risk weighted assets of the bank. RWA stands for the risk weighted assets of the bank. To find the risk weighted assets, you have to sum all these risk weighted values. The sum of these risk weighted values is your risk weighted assets, is equal to sum of all these risk weighted assets. So essentially, the risk weighted assets of this bank is 35,700. So the next question asks you for the total assets of the bank. The total assets are not weighted by risk and would be a sum of the total value of these assets. So to find the total assets value, you will sum the value of all the assets of the bank. So essentially, the bank has total assets of 101,000, of which 35,700 are risk weighted. Why is this value less? This value is less than the risk weighted assets. What we see is risk weighted assets is less than the total assets. This value is less than the total assets because some securities have zero weight. They are not influenced by the credit market or operational risk. The more securities that have a zero weight, the lesser the risk-weighted assets. So once you have the risk-weighted assets, the next question asks you for the percentage of total assets, uh, which is risk-weighted assets. So we have to find the percentage of total assets, which represents the risk weight. To do this, you'll have to find risk-weighted assets as a fraction of your total assets. So risk-weighted assets as a fraction of your total assets is equal to the risk-weighted assets divided by the total assets. That's about 35.35. 35.35% of the assets of the company are exposed to credit risk and market risk in the essence that when the company faces tough times, these assets can erode. Okay. So after this, the next thing is if a bank has tier 1 capital of 4,545, what is the value of the following capital ratios? Tier 1 capital ratio, capital to total assets. To calculate this ratio, we have to divide the tier 1 capital with the total assets of the company. So our formula will become tier 1 capital to total assets. We already know that the tier 1 assets are 4545 and the total assets are 101,000. So we can calculate this value as 4545 divided by 101,000. It's 4.5%. This indicates that 4.5% of the assets are financed through tier 1 capital. Now, the next formula is tier 1 capital to risk-weighted assets. This will become tier 1 capital divided by the risk-weighted assets. So we know the risk-weighted assets of this bank are 35,700. What we do is the tier 1 capital divided by 35,700, we get 12.7%. What this implies is of the risk-weighted assets, 12% are financed by tier 1 capital. So if this the risk-weighted assets erode because of high risk scenario in the market, the tier 1 capital would erode by 12.7. So 12.7% of the tier 1 capital will incorporate the risk-weighted loss, the loss of risk-weighted assets. But after that, we don't have tier 1 capital. We will have to look at tier 2 capital. Okay, so these are the capital ratios. This ratio is primarily the capital ratio used by any bank because it uses risk-weighted assets as opposed to total assets. Now, the last question is, according to BASIL, the minimum tier 1 capital ratio should be 4.5%. This means that this bank with the given assets cannot issue more loans. So the tier one capital ratio focuses on the risk weighted assets. As given, we know that the common equity tier one ratio should be more than 4.5%. The additional tier one ratio, which is common equity plus additional, should be more than 6%. When you're calculating these risk ratios, it is important that the denominator is the risk weighted assets. To calculate the capital ratios for the bank, the denominator should be risk weighted assets. So what we are interested is this ratio, the common equity tier one plus the additional tier one divided by the risk weighted assets should be more than 6%. If this ratio is more than 6%, it is good and the bank can continue its operation without problem. If it is less than 6%, then it's a red signal and you will have to look at multiple things. So what we know is currently tier one capital to risk weighted assets is 12%, which is more than 12% is more than 6%. Therefore, we can say there is no issue with the company. It is doing perfectly fine. So since the tier one to risk weighted assets more than 4.5%, more than 6% because it's tier one, not just tier one capital ratio. Tier one, the bank can issue more loans and take more deposits without any issue. Thank you for watching. If you like the video, please like and subscribe.